A lot of news articles have recently talked about the Great Recession of 2026, the next Great Depression. They've even called it the Great Reset or the Great Reset 2.0. Now, I'm not here to fearmonger, but I do want to give you some context on where this is stemming from and the actual factual basis for 2026. But more importantly, I'm here to help you set a true North Star for this year. So, if you're new to the channel, welcome. Happy New Year, and let's get going. Back in 1999, I joined the finance industry, the hedge fund industry to be precise. And back then it felt like all rainbows and roses. It was a boom for the stock market, and it felt incredible. We all felt we couldn't lose. But I remember a conversation I had with a mentor of mine telling me how the dot-com companies were all unsustainable, massive PEs, never heard of, and how a dot-com crash was imminent. Now, back then, I took this with a grain of salt. I was pretty young and cocky back then, but it still made me question if he was right. And upon further research, I started to get a little scared. Now, we all know what happened in 2000, 2001, and 2002. The dot-com crash. And again, I'm not here to fearmonger. I am here to state what the patterns are and how we can learn from it. But more importantly, how we can make better investment choices. The graph that you see here is the Shiller P ratio. I'm going to put the website that I got this from that I highly encourage you to check it out yourself. But suffice it to say, I'm going to go into 2 years, 99, and right now, which is 2026. Okay, so I pulled up the Shiller P ratio for 99. And as you can see here, it's 41.93. To give you a little bit of context, if you look historically at the S&P 500, the Shiller ratio mean should be between 16 and 17. So this is more than twice what the mean is historically. And I just pulled up the Shiller ratio for January 26, and it's 40.3. You can check this for yourself by going to the website. And not to make anybody be fearful, but I just want to do some comparisons between nowadays and 99. I do have to put out a disclaimer, of course, that nothing in this video is financial advice. To please do your own research. Investing comes with risk, including loss of capital. Always consult a financial professional. A lot of finance YouTubers are going to recommend certain stocks or hype them up. I'm never going to do that for you. I'm simply going to show you tools that are going to help you navigate finance and help you make much smarter investment decisions. And I hope that you appreciate the sentiment of this channel. Okay, back to the program. The dot-com bubble wasn't about the internet being wrong. It was about valuations and getting ahead of reality. The internet changed everything. Back in 99, investors were not paying for businesses. They were really paying for the possibility. Companies were valued on clicks, page views, and first mover advantage, while profits were optional. It's kind of a joke to think about it now. And then reality finally arrived, and it wasn't gentle. Do you see any parallels right now? Well, I think it's AI. I think it's artificial intelligence. You cannot really get away from AI nowadays, and AI is not a fad. I'm not saying that. But what I am saying is that paying infinite multiples for early stage monetization in artificial intelligence is a mistake. Artificial intelligence is going to reshape medicine, law, logistics, architecture. But just like the internet reshaped commerce, we're repeating the same pricing error. We're valuing companies based on model size, GPU capacity, user adoption curves, vague promises about future pricing power. But unfortunately, we're ignoring what ultimately matters: free cash flow, capital intensity, and dilution. So in 99, the story was losses don't matter, scale is everything. But in 26, the story is burn doesn't matter, compute is everything. Different vocabulary, but it's the same math problem. And here's the trap. Most AI platforms today don't have pricing power yet. They have cost curves that rise faster than the revenue and business models that still depend on constant capital. That's not innovation risk, that's a valuation risk. So the question isn't, will AI change the world? I think it will. But the real question is, which companies will turn adoption into durable cash flow without needing fresh capital every quarter? Because in every bubble, the technology survives. We still have the internet, but the prices do not. So if the AI bubble deflates, what actually survives? Not predictions, not hype, fundamentals. The same traits that worked in 2000 to 2002 are probably going to work again. So these are the 5 metrics that I believe will survive the bubble. Free cash flow yield, low capital intensity, debt to free cash flow discipline, ROIC, and shareholder yield. Now, don't worry if you don't understand these terms right now. Some of them I covered in previous videos, and I'm going to cover the ones that I haven't covered yet in upcoming ones. But the bottom line is this. The pattern is that the dot-com crash didn't destroy the internet. It destroyed weak balance sheets. And the same thing is going to happen with AI. So you don't need to predict the bubble. You just got to own the businesses that survive it. Thank you very much for watching the video, and I hope you found some value in it. Please hit the like and subscribe button, and please share this video as well to anybody who you feel is an investor that is intimidated perhaps by the financial terminology out there. Thanks again. Enjoy 2026. I hope it's very prosperous for you, and I'll see you in the next episode.